You're listening to the Real Estate Runway podcast, powered by QUATTRO CAPITAL, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family. Today we have a QUATTRO Roundtable edition. Kim, Wendland, and I are going to speak about our economic perspectives, just what's going on in the world today, what is economic long COVID, and where's the real estate market going? So let's get right into the show. But before we do, if you get any value out of this show, please like us on YouTube and leave us a 5-star review here at Real Estate Runway on Apple Podcasts. Leave us a thoughtful comment. That is the way we reach more people just like you. So we appreciate you for that. We read every single one of them and love everyone that we've had. And if you want to apply to be on the show, please visit us at thequattroway.com/podcast. If you'd like to email us, request a topic, say hello, podcast at thequattroway.com. And folks, we are on all the social medias. We even have a TikTok now. Real Estate Runway is on TikTok, and Team QUATTRO Capital, one word, no special characters, on LinkedIn, Instagram, Facebook, all the places. So we'll see you there. Let's get right into the show. All right. Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast, QUATTRO Roundtable Edition. I'm joined today with the magnificent Kim Wendland over from Asset Management, and honestly, one of the economic brains of QUATTRO Capital. Kim, welcome back to the show. How are you today?
Oh, love it, man. I love your show, our show, and I love what's going on here. I tell you what, the sky is blue, the weather is warm, spring is here. I'm so excited about it.
Yes, my sky is blue also, but it is 58 degrees and the wind is blowing. So I don't know how that happened in Tennessee today, but here we are.
Spring's on its way. It's blowing in.
It is. Well, folks, and by the way, as we're getting into this, I'm going to tell you that I live with little bioterrorists in my home. Why do I say that? I have young children, and Kim is seeing me on the first day post about a week of the stomach flu. So if any of you know what that is, anything coming out of the daycare world is the most rancid thing you've ever seen. So pray for me. If you have bioterrorists, I pray for you. They live in your home and they get you when you least expect it. So I'm back in action. Happy to be here today. But today, we're going to get into some interesting economic discussions on just what one of our favorite economists has a great analogy into how we actually got in the situation that we are. We can talk about the Fed trying to induce a recession and why they think that is, but then we can look at the more practical aspect of what this analogy on the current economy really is and really means. And then maybe take it in. We'll go into, folks, where are we going from here? What do we expect in real estate? And Kim's going to help me do that because she is just as much, if not more, of an economic nerd than I am. So how's that sound, Kim?
I love the conversation. Sounds great.
All right, let's take it back to one of our favorite economists, Dr. Peter Linneman, and he recently published his quarterly Linneman letter. And he's been talking about this concept of economic long COVID. I think you give one of the best explanations of this. So I'd love to just tee it up there. And what is that concept and why does it matter with where we are today?
I love his analogy. And like you, I'm a Peter Linneman fan, probably too much. But I hear the wisdom of his words echoing through all of the economic conversations, which I think is why we gravitate to it. But when you think about what people were suffering with COVID, it wasn't like the symptoms ended for everyone just because you didn't test negative, because you didn't test positive for COVID anymore. A lot of people, over a third, had these lingering effects that eventually got better for most, but not always and not real quickly. And it took a long time, sometimes months, sometimes years. For me, it was a year. For my husband, he still doesn't have his smell and taste back. When you think about human bodies and how complex they are when they go through trauma, some things work better than others coming back through it. But economically, we have a complex, super complex economy. And some things thrived at different times than others. You saw it in the tech market. Good grief. So having spent 30 years in the technology world, when we were in the middle of the shutdown, it was so amazing to see that 20 plus years of effort we had all put into something all of a sudden be like mission critical for every little kid trying to go to school. And it was phenomenal to see business be able to continue in many cases with some pretty positive continuity. So technology came to the forefront. Travel was a disaster, right? Nobody was going to go anywhere. Hospitality, same thing. But now they're reverse. People are wanting to travel, they're wanting to go, they're wanting to get, and the additional staff required to do all that technology has waned a little bit. So there were layoffs, but not below their pre-COVID norms. So it's very interesting when you start trying to think about one economy with such diversity in the sectors, how some of it's going better than others. And I think that's one of my favorite things about Dr. Linneman's point. The economy has long COVID. You and I joke about it all the time. Never before since Noah has the global economy shut down, especially all at once. So, of course, it's been a stutter start getting it back going. But now that it is going, there's plenty of us who can, what's the word, armchair quarterback, the Fed chair, because each of us look at this complex economy from a particular lens. And depending upon the lens that you're looking at the economy and what you need out of the economy, what the Fed's doing helps or hurts. And so for us, it's been a mixed bag. There was some things that have helped, there's some things that have hurt, and it's really an interesting time. And I'll just land the plane this way, Chad. We're living through economic cycles that normally took 2 to 3 years to evolve. They're changing every quarter. And so the volatility of the change as we get back to economic normal, whatever that is, the volatility of change, I think, has really been one of the most difficult things to handle in business right now.
Yeah, I would agree with that. And folks, going back to we just shut down the economy 3 years ago for the first time since Noah's Ark, and we're still talking about it. Why are we still talking about it? Well, that's a monumental thing. Think about what I just said. We shut the world down 3 years ago. It's not been that long ago, and we've been dealing with the repercussions of it ever since. What are those repercussions? Well, in 2020, we had mass layoffs. We had government stimulus. So we printed a lot of money. We were just trying to keep food on the table so that we could all stay at home and get past the pandemic. Then we get back to work a little bit in 2021 and most of the bit in 2022. And all of a sudden we had this thing called inflation everyone was talking about. Who's tired of that word? I mean, inflation, right? We haven't
Who
talked
started
about
paying inflationary
Yes.
prices?
we hadn't. I mean, inflation was always this 2% thing we've dealt with, and now eggs cost $7. It's ridiculous. When you think about it, what is the lasting or the economic long COVID symptom? The cause was we shut down supply chain, we pumped a lot of money. The effect was, in simple terms, all of a sudden we don't have enough things to buy because we shut down supply chain for a certain time. And then, oh, by the way, everyone now has more money to go buy them. So if there's only 50% of the eggs available in the world that there used to be, eggs is a bad example. If there's only 50% of the clothing garments you want to buy available, well, now if you have $2 instead of $1, you might be willing to pay $1.50 for that same thing, right? And so it all goes back into supply and demand. And oh, by the way, we gave everybody more dollars, so they're willing to pay more for the same thing, which means the dollar's now worth less because we put more dollars in the pool. This is the economic long COVID symptom that Kim and Dr. Peter Linneman are talking about. And effectively, this is why we had a massive run up in inflation. It was a supply chain induced phenomenon. And now we're just watching everything in the news. The new thing we're sick of is when are interest rates going to stop rising because we're tired of watching, we can't go get a loan for our car or whatever it is that you want to hear. We're seeing banks fail and all that kind of stuff. So maybe let's talk about that for a minute because that's where we are today. And then we'll go to where we are going forward. The Fed seems to be convinced, Kim, that they have to create a recession. They're hell-bent on creating a recession because they think the economy is overheated. Dr. Linneman and other economists would suggest it's not overheated. You're just dealing with the economic long COVID symptom of turning everything off and putting money in the system, which was supply chain induced inflation. But here we are. I guess, do we expect the Fed to just go ahead and cripple the economy or just keep going until, in your opinion here, until they get to this nebulous recession? Or do you think we've achieved the goal? What does the data say in your eyes today?
Well, I'm no economist, so let's start there. But I do want to share a quick context for people who may not be Fed followers. The Fed has two levers. Like they're driving a truck and they've got two levers. One is interest rates, and the other is the amount of money in the economy. That's it. They can add money supply, they can increase interest rates, they can decrease interest rates, they can reduce money supply. That's it. Those are the only two levers. What's unique about this time is that, and they openly say they were slow to the table, anticipating interest rates. But let's remember, the Fed operates out of the rearview mirror, not the windshield. They study data that has come in, not predict where things are going in the future. And so by definition, they're reactive. That is their role, to be reactive. So if you just accept that premise, like it or no, that is, they've got two levers and they work out of the rearview mirror. So in the Fed's context, they have done two things simultaneously, which has only been done at one other time. And that the two things they did was at the same time they were raising interest rates. They were at the very same time dramatically reducing the money supply. That double whammy, those two things happening at the same time and at historically fast paces, were destined to break glass. And it did. So what were the things that we saw break first? Well, if you're in real estate, it was much more difficult to get a loan. The price of rate cap insurance was insane because they were guaranteeing they were going to have to pay out on the first month of mortgage. When you're increasing the interest rate by 3/4 a point, half a point, and you do that over and over again, it is intense, right? So their goal of slowing down the economy was intense. The part that did not get as much press coverage because it's not as easy to understand is the part about the money supply. You'll hear they'll talk about quantitative easing. That means increasing the money supply. Quantitative tightening, meaning they're reducing the money supply. And they were reducing the money supply very rapidly. So what does that mean? How does the money supply go? Well, that's all about how liquid the banks are. So if the banks are receiving Fed money, then lending is easy. If banks are receiving less money from the Fed, lending is more difficult. So at the same time they were making the parameters difficult for loans, they were also constraining the amount of money for loans to be available. And in a capitalist economy, what makes the world go round is two things: consumers buying and selling things, and businesses investing and building new things. And both of those are required for a healthy economy. And we were slamming the brakes on both at the same time. So what that said to me is that when they looked at the rearview mirror, they saw a tsunami and they were a little freaked out and they were trying to slow it all down. But I don't believe the phrase, and I hear it a lot, and I know, Chad, you said it in jest, but, when we say the Fed is hell-bent on creating recession, I think that's a little bit disingenuous because I believe they're well-intentioned people. Maybe you guys out there can write in the comments, tell me how naive I am. But I truly believe everyone is acting in the best interests of the country. The problem is, how do you see the economy? And when you have so few levers to pull, what are you going to do?
Yeah, I love that. And personally, I prefer to picture them as a creature with teeth and fangs as they're portrayed in the book Creature of Jekyll Island. But yes, they're real people trying to serve a function in this economy. And wow, this is incredible. And so it's you gave a lot of good context there. And maybe we're not trying to cripple the economy, but in your opinion, do you think the rearview mirror is starting to show the result that this campaign was meant to produce at this point in time?
Yep, great question. I think the answer is yes and yes for both levers, right? We know, let's start with the money supply. We know when they broke things, like when all of a sudden, when SVB Bank failed, a third of the money they were reducing in the bank supply immediately reappeared within a week. So the fact that they went till something broke and then they recovered it, like that was an interesting, very interesting behavior. And for them to respond so quickly was almost like they were afraid they were going to break something. And so they had stuff in reserve ready if they did. And the fact that happened was very positive in the sense that at least they took action to reverse course. As it related to interest rates, I had to go to one of our properties, Chad, down in Kerrville, Texas, outside San Antonio. And so I had a wonderful 3.5-hour drive up there and back. And it was just economic podcast after economic podcast, all the favorites. I had my top 10 list. And literally, you all know that economists rarely agree on anything. But universally, everyone I was listening to and have continued listening to and reading, the net of it is they all believe we're past peak inflation. Sure, the inflation is still with us, but the pace at which is rising is slow and slowed dramatically now for more than a quarter. So that is a healthy sign the Fed is actually done their job in cooling down the economy. What nobody has any way of knowing, including the Fed, is what they're going to do next because it'll all depend upon their data. But the fact that there's a legitimate, healthy conversation with real data behind it, not just I wish, I want, but like legit data, it's making it harder for them to decide. And Fed Chair has said over and over and over again that he cannot relive the lesson of the past. And growing up in the 80s, and being a little bit of an economic nerd back then too, I watched what happened when interest was not under control and they stopped raising interest rates to relieve pain. And what happened was a roar of inflation even higher. Like I remember the days when my dad, your grandfather, literally bought a house for 19% interest. He was walking around with a drink in his hand trying to absorb what he just signed that day. Like, it's just insane. And of course, he refinanced out of that as fast as he could. But the point being that times could have been much harder with interest rates because when you look at the charts of where we were versus the 1980s, we were only about halfway there. We were on the way, but we were only halfway there. So I was grateful, having lived through that time, I was really grateful that they were taking action. And I was super grateful they took action when they realized they were breaking things. So your question, what do we think they're going to do? I think they're still going to be reactive out of their abundance of overcaution. Like abundance of caution is good. They probably have a little much. The probability is more that they will likely do another quarter. Who knows after that? It'll depend on the data. But here's what I do know, Chad. What we're living right now in fluctuating interest rates, inflationary times, and recession, probabilities of recession. In all three of those scenarios, what is like the number one investment to be in? It's real estate. And why is that? Well, it's because the value of your money that's in that investment is an appreciating asset. When inflation is high and wages are growing high, that means rent rises. And it has been for a long time. In addition, you have the actual appreciating value of the property. Sure, cap rates are wobbling, but if you're in value add projects that were already under market, you still have plenty of headroom to come up. And then the third piece, recession. Well, when everything else is falling apart economically, people still need what? Your favorite saying, air,
Food, water, shelter.
Shelter. Exactly. And I think you stepped on that. Say it again.
Food, water, shelter. 3 basic needs of every human.
Yeah, you have to have it. I would just add air and then we're good. It's just a matter of working through what's the right play for any given asset and what's happening in every individual market. Because speaking of the economy as the whole, is like talking about quote unquote the real estate market. There is not a national real estate market. There are individual markets that are dealing with their own local economies and their own supply and demand areas. And that's where real estate is a really interesting game.
That's exactly it, Kim. We've just finished talking about where we are in the economic process here, what we've been feeling, what got us here, and how we've been feeling some economic cycles that usually take years and quarters, which is very interesting. But we were starting to pivot into real estate. And Kim, this is my favorite part of the show because let's talk about what do we think we should expect going forward in the real estate market. We've talked about we probably passed the peak, maybe supply or supply chain and building products and things like that will start to normalize. Some of them already have. What does the real estate investment landscape, in your opinion, look like? And I may add some thoughts as well after you go.
Yeah, that'd be great. I'd love to hear your take too. Chad and I are on quote unquote opposite sides of the transaction. He's the acquisition side and I'm on the asset management side. So he's more of a hunter. I'm more of a farmer. And it's interesting to hear the difference in perspective. So from an asset management angle, you're always thinking about occupancy. You're thinking about whether or not you can achieve the business plan. And you want to know that your lender is going to be providing the funds from their CapEx draws, that if you have a bridge note. So from those three things, occupancy is really interesting. As many builders came out swinging in 2020, and there was a lot of growth in that space, especially through 2021. In 2022, it began to get really hard for them based on the interest rate challenges and the money supply problems. It was tough. But in certain key markets, they built a lot where I used to live in Austin area, for example, for over 20 years. And everywhere I went, another 3-4 apartment complexes on every street. Literally, I'm not overstating the case. Same in Charlotte, North Carolina. And why were they doing that? They were doing that because there is a massive supply and demand imbalance. There is way more demand for housing than is in either of those cities. So the question becomes how quickly in those markets, how quickly can you absorb that new inventory? And we're seeing in certain markets where investment in construction has been very heavy that there are some challenges. So for example, in Texas, Austin and Dallas are leading the way with the largest volume of we'll say net new units coming online. Dallas will probably break even according to most of the projections I've seen. Austin's going to be underwater a while because they've overbuilt. But at the same time, I really don't believe that. Having lived there, I'll be curious to see if the trough is as deep as they anticipate some people. Charlotte, North Carolina, the same thing. There is a massive supply imbalance, but they have a whole bunch of units coming on all at the same time. So it's going to take about a year to 18 months for those to be absorbed. And I think we're going to see, instead of the average occupancy over 95%, which is, by the way, historically insane, that is not the norm by any stretch of the imagination, we're probably going to be looking at the upper 80s in some of these markets for a short time. But there's other markets, Chad, like some of them that we're in, like Houston. Even though they've been building a lot, there's still so much demand there, so much influx of people and work that it's going to be the opposite problem. They probably need to build more. And even we love this market, Alabama, Huntsville, Alabama, even in that amazing market where they've built a whole lot all of a sudden. And by the way, they needed to. There was not enough housing there. Even though that's happened, it's going to be difficult, and they're already in the upper 80s on occupancy. But the suburb where we've invested, which was not Huntsville, but just outside of that, Decatur, is still in the upper 90s because where that geographic location is has a lot of demand, but none of the construction. So the root of all of this, Chad, comes back to the historic supply and demand problem in general that we have across the nation. Individual markets, some up, some down. But overall, when you look at the national numbers, we're way below. In fact, if we started building the most we ever built, it would take 20 years to catch up. So I'm not concerned about the volatility. I'm just watching quicker to see how quickly that net absorption can have. Because when you need to make up for $3.3 million, not dollar, 3.3 million single family homes and over 1 million multifamily units, that gap needs to be closed because we keep growing as a population.
Yeah, some incredible insights there. And to add to that, I mean, the occupancy is huge. And I think that's one where mainly driven by supply showing up that you mentioned. A lot of it was started in 2020. It's showing up. It usually takes about 2 to 3 years to deliver. Well, here we are, 2023. And the interesting thing is, yeah, we're seeing occupancy down in some areas. And look, the national average, it's moved. I'm not going to lie to you, it's decreased. 96.2% to 94.8%. Okay, so we
Oh,
haven't had
federal
that.
crisis.
Well, it's still a great number, y'all. And it's in some of these markets, yes, temporarily you'll see it in the 80s, but that's a sign of strength because the question is now how quickly are they going to absorb that and get right back up? And that really only affects certain populations of properties, by the way. Not every property is going to feel that. In general, we think it is a fantastic time to invest. And if you have courage and capital, said by, again, Dr. Peter Linneman, since we're using his theme today, if you have
Yeah.
courage and capital when others don't, you're going to make a buck. And let me give you a simple analogy to describe what I'm seeing in the world. If you're a home buyer and you're like, gee, I'm going to wait to buy a home today because interest rates are too high. Well, you and about 90% of the home buying world out there, right? And so guess what's happening right now? A lot of people just aren't buying homes because they think the rates are too high. And fair, I get you. But that also has created a bit of a depression, not a depression, a decrease in the sales price of homes because there's not as much demand and there's more supply. So you have two options. Today, the option is you can deal with higher interest rates and you can probably get a better price on your house you're going to buy as long as you can stomach the interest payment for a time, refinance it later. I mean, what do they say? Marry the property, date the rate or something like that.
Love
Marry
that.
the basis. If you can have an opportunity to get a little better price on a project today and just deal with a 6% loan or whatever it is, buy the property. The converse is going to be true. The converse, give it 2 years from now. Let's say interest rates normalize, they stop going up and we reach whatever our new normal is. Maybe they come down a little bit, whatever the new number is. Maybe let's say they're 4%, whatever, something in the middle. Everyone's going to say, okay, well, that's the new rate. I'm going to go back to buying houses because I want to live my life and I just had a kid and I need another bedroom. Well, those prices are going to go right back through the roof because all of a sudden everyone's off the sideline. So I say all that to say that really exists in every sector of the real estate world today. Transaction volume is down because there's a lot of capital on the sidelines. If you can manage to put a deal together or find an investment with a sponsorship team or something like that, where you can get into an investment that is still in a good submarket, like the local economy is still doing good. The fundamentals are still doing good. Yeah, you're probably not going to get as much debt as you would like, and maybe cash flow isn't as great out of the gate, but they're probably getting a much better price, like to the tune of, if we're talking cap rate, a lot of cap rates are up 100 to 150 basis points right now. Use a little more equity and do the deal. Make the investment. Invest in that deal. Because as long as the sponsor is paying attention and smartly dealing with the debt market of today, there's a lot of good buys out there right now if they actually can agree on a contract price. So I think it's a great time to invest. I think it's harder to find deals out there right now. The fundamentals aren't the problem, Kim, as you've mentioned.
No.
There's, at least not in our markets, we haven't seen rents roll back. Maybe rent growth has rolled back. It's not growing at 20% organically anymore.
That's 15, Chad.
Yeah.
Like, I mean, we have set ourselves up with some expectations rather than saying, wow, that was a beautiful wave. Wasn't that amazing? Human nature is if you see something, you think it will always be that way. We need to acknowledge those were some beautiful, amazing waves and keep surfing, right? Like, it's time to catch the next wave that'll be even better. So when we're talking about occupancy, that also makes me think about how grateful I am, Chad, that the prices of things are starting to stabilize. Back when the supply chains were super disruptive, like we were having to hoard appliances to be able to churn units and flooring and all of that stuff that was not part of an original business plan, but what you need to do to be able to accomplish the business plan. So the fact that the supply chains are normalizing, pricing is becoming more in line, that is all very good for existing projects that you have underway. And the third piece of all of that is the rent growth. And here's the number one metric you need to be watching when you're thinking about rent growth. And that is the rent to income ratio. Basically, in order to qualify to lease an apartment, you need 2.5 to 3 times the income each month that's greater than the rent. And if your market's average income hits that metric or better, you're fine there's actually no problem whatsoever. Most of the conversations that are related to income and rent challenges are in the states where you have extremely high populations and a lot of interference. For example, San Francisco, known to be one of the most expensive places on earth to live. New York City, known to be one of the most expensive places to live. And if you're living at the most expensive place to live and prices are even higher, it hurts a whole lot more. But when you're in an economy, say, like a Huntsville, where the average income to rent ratio is so good that it's so far below that there's plenty of headroom there and to have a healthy rent base, that's why we say real estate is local. It's not national. And comparing a Huntsville or a Houston, even a Houston, comparing that to a San Francisco or a New York makes no sense. They're completely different animals.
That's exactly it. I think, Kim, would you say probably any stress that we have today in our portfolio, it really has nothing to do with the real estate itself. We have some lending decisions we're dealing with, but it's really got nothing to do with the real estate. The fundamentals are strong. It's good stuff.
Yeah.
So.
It's a wonderful investment. And Chad, I know we're running out of time, but I just want to land my perspective with this. And it's my favorite Jim Rohn quote that Coach Trevor McGregor introduced me to. And it really is what we're living today. And here's the quote. It says, "The same wind blows on us all, the winds of disaster, opportunity, and change. Therefore, it is not the blowing of the wind, but the setting of the sail that will determine our direction in life." So go out there, folks, tack those sails, make the adjustments you need to do so that you accomplish your goals. You can do it. We can do it. We'll all do it together.
All right, folks, I hope you enjoyed that discussion. Just Kim and I bantering back and forth on where are we economically and just where's the real estate market going. Folks, it's a great time to invest in real estate. The fundamentals are still there. There's no tweet that can be sent to send it up and down. And you're probably going to get better pricing on your acquisition right now than you have in years past. So love it. If you got any value out of this show, we'd really love a 5-star review and thoughtful comment here at Apple Podcasts. Those ratings really help us push the show out. And we'd love to see you on social media. Real Estate Runway Podcast is on YouTube and TikTok. And Team QUATTRO Capital, one word, no special characters, on LinkedIn, Facebook, Instagram, you name it. Scroll down in the show notes. You'll find them right there. Until next time, this has been another episode of the Real Estate Runway Podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.